Please come to IAS 16 again. Come to paragraph number 12. Subsequent cost. What is the treatment of subsequent cost? Will subsequent cost be capitalized? Many times subsequent costs are not capitalized, like if they're in the nature of repairs and maintenance. Okay. If they're in the nature of repairs and maintenance, then subsequent costs are not capitalized. But subsequent cost can be capitalized if they meet the recognition criteria. They should meet the definition of property, plant and equipment. The asset must generate benefit. The expenditure must generate benefit for more than 1 year. Future economic benefit should flow to the enterprise, and the cost can be measured reliably. Then in that case, you can capitalize the subsequent cost. Next is replacement. So if there is a replacement of a part of an asset, then this replaced part will be capitalized and the old part will be derecognized. Similarly, if there is a major inspection, then this major inspection will be capitalized and previous inspection capitalized will be derecognized. Next paragraph taken directly from IAS 16. The carrying amount of those parts that are replaced is derecognized. When each major inspection is performed, this is for major inspection, like in case of aircraft, it happens. They have to undergo a major inspection periodically, because in case of aircraft the risk is very high. So therefore they are compulsorily required to undergo major inspection. Its cost is recognized in the carrying amount of the item of property, plant and equipment as a replacement if the recognition criteria are satisfied. Any remaining carrying amount of the cost of the previous inspection, suppose you have done the inspection next time, so any remaining carrying amount will be derecognized. Previous inspection cost, to the extent which is not depreciated, will be derecognized. So the treatment of inspection is similar to replacement. This occurs regardless of whether the cost of the previous inspection was identified in the transaction in which the item was acquired or constructed. Okay. Even if you are not able to identify how much cost was involved in the previous inspection, then also this treatment is required. Then your question will be, how do I know the previous inspection cost? So the standard gives you a formula, a method to arrive at the previous inspection cost if it cannot be identified. Last paragraph underline, how to identify the previous inspection cost. If necessary, the estimated cost of future similar inspection may be used as an indication of what the cost of the existing inspection component was when the item was acquired or constructed. This is written there, underline only. Now see the meaning of this paragraph. Suppose a major inspection is carried on here after 3 years. After 3 years, is it right? 10 lakh rupees. So what I'll do, I need to find out what is the present value of this inspection at this point. If today the inspection would cost 10 lakh, how much it would have cost 3 years ago? So you will take 10 lakh, divide by discounting factor, suppose 10%, 1.10 to the power 3. So this will give you the inspection cost at the beginning. So this comes to, let us say, around 7.5 lakh, 7.5 lakhs. And you will find out what is its value today. So to find out the value today, you have to depreciate it for how many years? Minus depreciation for 3 years. So using the current inspection figure and using the discount rate, you reach the possible value at the beginning. Once you reach this value, you depreciate it and find out what is the value on the date of inspection, again second inspection. That amount will be derecognized. That amount will be derecognized. I'm going to take an example on this. Dear student, write one question first in the notebook. This is not printed. Write one question on inspection cost. Two problems we will take, one little easier one on the screen and then a possible exam oriented question. Question, write down ASF acquired an aircraft for rupees 15 lakh. ASF acquired an aircraft for rupees 15 lakh. Only in the question, okay? Not in reality. On 1/4/17, it has a life of 15 years. It has a life of 15 years. ASF is required to get the aircraft. ASF is required to get the aircraft inspected every 3 years. Inspected every 3 years. To check the travel worthiness. To check the travel worthiness. To check the travel worthiness. As per the regulation, they have to get it inspected every 3 years. On 1/4/17, it carried out inspection. It carried out inspection at a cost of rupees 6 lakh. It carried out inspection at a cost of rupees 6 lakh. On 1/4/2020, on 1/4/2020, means after 3 years, it incurred rupees 7,50,000 as the cost of the new inspection. As the cost of the new inspection. Show treatment. Show treatment means how much depreciation you will provide in first, second and third year, and then how much depreciation you will provide after third year. Right? Next is how will you do the presentation in the financial statement. Okay. So write down first 1/4/17. 1/4/17, you will capitalize two items, aircraft cost also and inspection cost also, but you will depreciate them using different life. This main aircraft will be depreciated over 15 years and inspection cost will be depreciated over 3 years. So write down this much first. ASF Limited will recognize aircraft of rupees 15 lakh and depreciate over 15 years. And depreciate over 15 years. And recognize inspection cost. And recognize inspection cost at rupees 6 lakh. At rupees 6 lakh. And depreciate it over 3 years. And depreciate it over 3 years. And depreciate it over 3 years. So this is the day one entry. You will capitalize both and you return a note what will you do with the depreciation part according to the respective useful life. Then you write down what you will do from 1/4/17 to 31st March 2020. Write down 1/4/17 to 31st March 2020. depreciation charge. How much depreciation total you are going to charge in the statement of profit and loss? This 15 lakh divided by 15, 1 lakh rupees each year for aircraft, and this 6 lakh divided by 3, 2 lakh. So that depreciation charge for the first 3 years would be 3 lakh rupees. Is it right? 3 lakh? Yes. Write the calculation in detail. To get full marks, write calculation in detail. Rupees. Depreciation on aircraft 1 lakh. Depreciation on inspection cost 2 lakh. Total depreciation to be recognized in each of the first 3 years would be 3 lakhs. Okay. So after 3 years, the inspection cost has been fully depreciated. You incurred another inspection cost of 7,50,000. So that will be depreciated now over 3 years. So depreciation charge for aircraft will not change, but the depreciation charge of inspection cost would change. So now write down 1/4/2020 to 31st March 2023. Next 3 year depreciation charge. Depreciation charge, right hand side rupees. Point number A. Depreciation on aircraft 1 lakh. Depreciation on aircraft 1 lakh. And depreciation on inspection cost, this time it is 2,50,000. Depreciation on inspection cost 2,50,000. Total depreciation 3,50,000. Total depreciation 3,50,000. Is it right? So this is the answer of this question. Now we'll take one important question, which is question number. We have to just check the question number 62. 62 number. Mark important 62 number. MS Limited has acquired a heavy machinery at a cost of rupees 1 crore with no breakdown of the component part. Right. 1 crore is the total value of this asset. It has got component, but they have not given the breakdown of the component part. Life is 10 years. At the end of the 6th year, how many years are over? 6 years are over. One of the major components, what is that component? Turbine, requires replacement. As further maintenance is uneconomical, the remainder of the machine is perfect and is expected to last for the next 4 years. The cost of the new turbine is 45 lakh. Now when you replace this turbine, it will cost you 45 lakh. But we don't know how much did it cost you when you had acquired it 6 years ago. So you have to do backward working using 5% discount rate. Assume 5% discount rate. Means had I purchased it 6 years ago, how much it would have cost us? And then the method of depreciation is straight line. So two calculations you have to do. First you have to find out the value of this 45 lakh 6 years ago. And then what is the book value of this turbine today? So you have to depreciate it for 6 years. My original estimated useful life was how much? 10 years. That means you will calculate depreciation assuming 10-year useful life. 6 years are over. So you have to find out what is the book value of this turbine at the end of 6th year. Can the cost of the new turbine be recognized as an asset, and if so, what treatment should be used? So this is a problem of replacement of a major component. Old part will be derecognized, new part will be capitalized. The cost of the old part is not directly given in the problem, but then they have said you can use the current market price of the replaced part and use it as a basis to estimate the cost of the original turbine part. Is it right? So what will you do? First you have to find out the value of this 45 lakh. First understand and then you can read the answer. What is the discount rate they have given? 5%. And how many years we have to go behind? 6. Take your Chinese calculator. 45 lakh divided by 1.05, 6 times equal to how much? 33 lakh 58,071 approximately. If your institute material gives you 33,57,900. Okay, so we can take this number for understanding purpose. Now this was the estimated value of the turbine 6 years ago. It will be depreciated for 6 years. What is the original estimated life? 10 years. So what will be the book value of turbine after 6 years? So you can take 33,57,900 into 40%. Why 40%? Because 6 years means 60% life is over. So tell me the 60% of this figure. No, 40%. 160. This 40% is clear. Life is 10 years. Means every year you depreciate 10% of the asset value. So in 6 years 60% is depreciated. 40% is remaining now. So this is the book value. So you will say this amount will be derecognized and 45 lakh rupees will be capitalized. Okay. So the answer will be presented like this in your book. Just pay attention. The new turbine will produce economic benefit to MS Limited and the cost is measurable. Hence the item would be recognized as an asset. The original invoice for the machine did not specify the cost of the turbine. However, the cost of the replacement 45 lakh can be used as an indication, usually by discounting of the likely cost 6 years previously. So if the appropriate discount rate is 5%, 45 lakh discounted back 6 years amounts to 33 lakh 57,900. We have discussed it. Then the current carrying amount of the turbine is required to be replaced is 13 lakh 43,160. You have learned how to calculate it? Yes, take 33,57,900 and minus 60% or into 40%. That is the original cost minus accumulated depreciation of past 6 years on straight line basis. The cost of the new turbine is how much? 45 lakh will be added to the cost of the machine, resulting in a revision of carrying amount of the machine to 71,56,840. Now the student is asking how this 71,56,840 has come. So understand, the cost of the heavy machinery was 1 crore. Is it right? It has been depreciated for 6 years. So you have depreciated 60 lakh rupees, which includes the turbine also. So the opening balance of this asset is 40 lakh in the books, plus you are going to capitalize turbine new, and minus you are going to remove the old turbine and therefore if they ask you what will be the closing balance of this asset account, then this would be your answer. Is it right? Understandable? So very important question. Now next paragraph, government grant. Government grant will be discussed under IAS 20. Okay. So the treatment of government grant related to an item of property, plant and equipment is given in IAS 20. And when you go to IAS 20, you'll find one of the methods of accounting for government grant relating to PPE is you can use it for reducing the carrying amount of PPE. Okay. That is in IAS 20. Now comes one interesting part, subsequent measurement. Day one accounting is always at cost. Subsequent measurement, two models are permitted. Which two models are permitted? Cost model. That means whatever amount you have capitalized, continue with that. Less depreciation, less impairment loss, if any. Or you are also allowed revaluation model subject to certain conditions. Subject to certain conditions, you can follow revaluation model. That means you can bring the value of the asset close to its market value, so that in your balance sheet, the asset value appears closer to its market value. Revaluation model is permitted because there are many assets whose market value is much more than their book value. Example, land and building. Is it right? Or maybe some machineries also, or some other asset. Especially in case of land and building, the value actually goes up after the passage of time. So therefore companies are saying, I am showing 3 lakh land, but its market value is 30 lakh now. So therefore the standard setter said, okay, we will allow you revaluation model, but subject to certain conditions. What is the condition number 1? That you have to apply revaluation model for an entire class of asset. You have to apply revaluation model for an entire class of asset. Can a company choose cost model for one class of asset and revaluation model for another class of asset? The answer is yes. You can. Okay. So what do you mean by class of asset? Some examples are given in the standard, like land, building, machinery, vehicles, office equipment, ships, aircraft, furniture and fixture, bearer plants. So suppose you want to revalue building. You have 10 buildings of similar nature. Then you have to revalue all the 10 buildings. Then you can't do pick and choose that those buildings whose value have gone up, I'll follow revaluation model, and those buildings whose value have come down, I'll follow cost model. That you can't do. Otherwise, this may give rise to an opportunity to manipulate your financial position. So what you will do, measurement part, initial recognition at cost, subsequent recognition, you can follow cost model or revaluation model. Now what is cost model? Cost model is simple. What you normally follow, what companies normally follow, most of the companies follow cost model, easy to apply. You will capitalize the asset at its cost as discussed earlier, and after that you just have to keep on providing depreciation, less accumulated depreciation, and in case the asset has any impairment loss, minus any impairment losses. That is cost model, easy to apply. Practically also in all your offices, wherever you work, you will find you are applying this model only. Have you come across any company following revaluation model? No. You? No. Me? No. Okay. So all the students, including me, have not come across actually company following revaluation model. Maybe they don't even know that this option exists also, at least the accountant level people. Now next is, what is revaluation model? Revaluation model means an item of PPV will be carried at revalued amount. Now some condition you have to follow. For example, entire class of asset will be valued using revaluation model, but you can follow cost model for one class of asset and revaluation model for another class of asset. What is the reason for entire class being valued using one single model, revaluation model? So that you cannot do pick and choose, to avoid selective revaluation. To avoid selective revaluation, because then you can value that asset whose value have gone up, and you may not value, or you may not revalue downward for those assets whose value have come down. And to avoid the reporting of amounts in the financial statement that are a mixture of cost and values as at different dates. So if some buildings are cost model, some buildings are evaluation model, it is very difficult to understand the financial statement, right? So that is why one more reason is all assets in a class, same model should be followed. Only those item of plant, second condition, only those item of plant and equipment whose fair value can be measured reliably. Whose fair value can be measured reliably. If suppose you have an asset but its fair value cannot be measured reliably, you cannot apply the revaluation model. Shall be carried at revalued amount, being its fair value at the date of revaluation. So that will become the fair value, and any subsequent accumulated depreciation and subsequent accumulated impairment loss. Then revaluation date need not necessarily be the reporting date. You can revalue during the year also at any point of time, but most of the companies will follow either beginning or at the end, right? Okay, now we'll solve one question. Venus Limited is a large manufacturing group. It owns a considerable number of industrial buildings such as factories and warehouses and office building in several capital cities. What is that question number? 58. The industrial buildings are located in industrial zones, whereas the office buildings are in central business district of the cities. Venus Limited management want to apply the IAS 16 revaluation model to the subsequent measurement of the office building, but continue to apply the historical cost model to the industrial building. Now this is an interesting case. It has two types of building: industrial building, office building. It wants to apply two different models for these two different categories of building. Is this acceptable under IAS 16? It's a very tricky question. Can industrial building be one class of asset and office building be another class of asset? Use specific. Use is different, and hence in this example the company can say we have two types of building, two class of building, and therefore we can follow two different models. So Venus Limited management can apply the revaluation model to just the office building. The office building can be clearly distinguished from industrial building in terms of their design, function, nature, location, use, etc. So IAS 16 permits permits asset to be revalued on a class by class basis. What will be the carrying amount of the asset under revaluation model? You will take the fair value at the date of revaluation. Last time when you did the revaluation, take that value minus any subsequent accumulated depreciation and minus any subsequent accumulated impairment loss. That will give you the carrying amount. This will be the carrying amount under revaluation model. Okay. Frequency of revaluation. How many times the entity must do the revaluation? Has it been specified? They have only mentioned that the revaluation should be made with sufficient regularity. Revaluation should be made with sufficient regularity. Maybe you can choose 1 year, 2 year, 3 year time period. What you have to ensure, again one more condition, that in case if you have chosen revaluation model, there should not be material deviation from the fair value that would have been at the end of the reporting period. That means book value should not deviate too much from the fair value in case if you are following revaluation model. So frequency of revaluation is sufficient regularity. Items of PPE experience significant and volatile changes in fair value. So those items, this is the guideline they have given, where the fair value changes quite frequently, volatile, you can use annual revaluation. And those PP item where there is insignificant change in fair value, maybe you can do the revaluation once in 3 years, once in 4 years, or maybe once in 5 years. Next is after revaluation. One more condition. The carrying amount after revaluation should not exceed the net recoverable value of the asset. Is it right? That means you can't revalue to any extent you wish to. Upper limit will be what is the net recoverable value of the asset. Recoverable amount is defined in your impairment standard. Higher of the two, value in use or net or fair value less cost to sell. So there is an upper limit also. Now what about the accounting entry for revaluation? There are two possibilities, revaluation gain or revaluation loss. Either the value of the asset may be increased or decreased. The standard says if there is an increase in the carrying amount, then it should be recognized in other comprehensive income, OCI, and accumulated in equity, that means statement of changes in equity, under the heading of revaluation surplus. So gain will not be going through profit and loss statement. It won't form part of retained earning. It will form part of another reserve, which you can give a name called revaluation surplus. So that means the users will understand that this gain is due to revaluation of an asset upward. And in case if you are revaluing an asset downward for the first time, then it is a loss. First time revaluation results into loss. Then you will recognize the loss in the statement of profit or loss. Okay. Now next is subsequent revaluation. Accounting of subsequent revaluation will depend on first time revaluation. So first time revaluation is upward revaluation. Okay. And second time also upward revaluation. Upward revaluation on first occasion and upward revaluation on second occasion also. Same treatment again. You will transfer the gain to other comprehensive income in the statement of comprehensive income and you will show it as revaluation surplus. But if the previous revaluation has resulted into loss, but second time the revaluation has resulted into gain, what we will do? First we will transfer to P&L account the gain to the extent of previous loss. To the extent of previous loss, because earlier we had debited the P&L account. So the investor got less profit, less share in profit. So now we are returning it back to the profit and loss account, that revaluation gain, and excess over and above that as usual will be other comprehensive income, that is revaluation surplus. Second time suppose there is a revaluation loss on the second occasion, but first time it was revaluation gain. So what I'll do, the loss will be first adjusted against revaluation surplus. any excess loss will be charged to statement of profit and loss. First time was also loss, subsequently is also loss. Then the same treatment will continue. Now you draw a small diagram for this revaluation of asset. In case if you want to draw it fast, it will give you a quick summary of what you'll have to do. Revaluation of asset, for understanding purpose, first time revalued, and here the asset was revalued earlier also, previously revalued, means subsequent revaluation. Okay. First time revalued, two possibilities. Increase in value, yes, credit OCI, that is revaluation reserve, or it may be decrease in value, yes, charge to P&L account. Done. Now next is previously revalued. Increase or decrease in value, consider four possibilities. Four combinations are possible. Which are the four possibilities? Present increase plus previous increase. Increase plus increase. Both time increase. So treatment will again be the same. Credit OCI, revaluation reserve. Second combination is present decrease. Now it is decreasing. But previous first time revaluation it was increase plus previous increase. The treatment would be charge OCI. Revaluation reserve to the extent of previous increase. To the extent of right balance. And charge the remainder if any to profit and loss. To the extent of, it will be more appropriate to write to the extent of balance. I will explain you why I have written balance, because revaluation reserve may be reduced over a period of time for additional depreciation to be provided. Okay. And charge the remainder if any to profit and loss. So see, suppose we have to reduce the value by 100 rupees, but the balance in revaluation surplus is only 70. Then 70 you will first adjust against revaluation surplus, and 30 you will adjust against profit and loss. What is the third possibility? Present increase but previous decrease. So in this case I will say credit P&L account to the extent of previous decrease and credit the remainder if any to OCI. And credit the remainder if any to OCI. That is revaluation reserve. And the last is the simplest one. Present decrease plus previous decrease. You will charge to P&L account. Is it right? Is this understandable? Now, what about the entry to be passed in case of revaluation? Okay. Suppose your asset have to be revalued upward. What entry will you pass? Because in your books of account you have created two accounts. One is your asset account, which is at cost, and then you have also created one accumulated depreciation account. So practically we maintain two accounts, one for the cost and one for the accumulated depreciation. So now we have to increase the or pass the entry in such a manner that this balance moves to this balance. This is your before revaluation figure and this is your after revaluation figure. So that means I have to adjust both the figures in such a manner that we move from before to after. Two techniques they have allowed. How many techniques? Two. First technique is gross carrying amount is adjusted in a manner that is consistent with the revaluation of the carrying amount of the asset. So in first method, both these figures will change proportionately. Both the figures will change proportionately. We will change the cost figure also, and we are going to increase the accumulated depreciation figure also. Both figure will change proportionately. So that the same proportion which is here will be maintained after the revaluation also. Gross carrying amount may be restated proportionately to the change in the carrying amount. I am going to show it with the help of one example. Accumulated depreciation at the date of revaluation is adjusted to equal the difference between the gross carrying amount and the carrying amount of the asset after taking into account any accumulated impairment loss. So basically the accumulated depreciation will also be adjusted. It would be more like a balancing figure so that the difference between the gross and the net becomes accumulated depreciation. In case if there is any accumulated impairment loss, keep that also as it is and make the adjustment in the accumulated depreciation. Now we'll solve one small example here to understand this. Okay. Only follow the discussion on the screen. Notes are printed. Property, plant, equipment before revaluation. Cost or the value at that point of time is 1000. Accumulated depreciation was 400. And the net book value was automatically 600. 100 minus 1000 minus 400. Now what they have done? They have done the fair valuation and they found that the fair value of this asset is now 1500. So what is the revaluation gain? 900. From 600 I want to make it 1500 now. 600 to 1500. What is the change? 1500 divided by 600 is how much? 2.5. 1500 you want now. It was 1600 earlier. So what is the ratio? 1500 divided by 600. 1500 by 600, 2.5. I have to ask 6 times. 2.5. So what you will do? You will make the carrying amount of this asset also 2.5 times. How this 2.5 times has come? 1000 into 2.5. You make the accumulated depreciation also 2.5 times. 400 into 2.5. Is it 1000? So you will find your balance has become 1500. So how much adjustment you are going to make in the cost part? From 1000 you have to make it 2500. So you have to fill this gap by increasing it by 1500. Accumulated depreciation was 400. You want to make it 1000 proportionately. So how much this will change? 600. So automatically your gain will be 900. Is it right? So what you do, the simple trick you follow. First find out what is your carrying amount. Now 600. What is your fair value after evaluation? 1500. So what is the ratio of fair value after evaluation and carrying amount? 2.5 times. To take 2.5 of this number, this will become the gross carrying amount after evaluation. Take 2.5 of this number, 1000. Fill in the blanks. 1500 and 600. Now write one journal entry wherever you have the space there. What journal entry will you write if you follow technique 1? PPE account debit, हाँ जी, 1500. To accumulated depreciation, right, to accumulated depreciation 600, and to revaluation surplus 900. In bracket you can write OCI. This entry will pass. Okay, there is a simple method also. Okay, simple method is you remove the accumulated depreciation. Remove the accumulated depreciation is eliminated against the gross carrying amount of the asset, and then you pass the entry for revaluation gain. Okay, so same example we'll take. This is simpler. No need to do the proportionate calculation. Good for those people who are mathematically challenged. Okay, second method. Property, plant, equipment before revaluation. Same example we are taking 1000, 400, 600. And how much we want at the end? 1500. After revaluation we want 1500. So therefore there is a gain of 900. So what you will do in this case, you eliminate this 400 first. Eliminate 400, so that will be gain, and the remaining you apportion to carrying amount. This 400 you write first fully, make it 0. Accumulated depreciation, if you debit, it is a gain. Remaining gain you adjust in the cost or revalued cost. If you have to pass journal entry for technique number 2, write down 2 entries. Write down 2 entries. First you write accumulated depreciation account debit. Accumulated depreciation account debit. $400 to asset account 400. To asset account 400. Now take your calculator. Your asset account is 1000 right now. You have credited 400, so its value is right now 600 now. And you want to make it 1500. You want to make it 1500. So next entry will be asset account debit 900 to revaluation surplus 900. Calculation will be 1500 minus, in one bracket, 1000 minus 400. Okay. Effect is the same, but now the carrying amount of the asset will become 1500 and the carrying amount of the accumulated depreciation will become 0. So your journey will start from 1500 now. We'll take some practice here. There is a problem below. A Limited has an item of PPE with an initial cost of 1 lakh. On the date of revaluation, accumulated depreciation is 55,000. The fair value of the asset by reference to transaction in similar asset is assessed to be 65,000. Pass entries with regard to revaluation. Entry. What entry will you pass? Technique 2. Solve by technique 2, easier. First you eliminate the accumulated depreciation. So the first entry will pass accumulated depreciation account debit to asset account 55,000, 55,000. Accumulated depreciation balance has become 0. Asset account balance has become 45,000. But we want to increase the value of the asset to 65,000. So now my entry will be asset account debit to revaluation surplus 20,000. 65,000 minus 45,000. Okay. You want 65,000 and your book value is 1 lakh minus 55,000. So this is your answer for this question. Okay, now one more question. Is it printed there? ASF Limited purchased a land at a cost of rupees 50,000. Professionally qualified valuers have valued the land at rupees 70,000. This you have to write in the notebook. I think it is not there. Right. ASF Limited purchased a land at a cost of rupees 50,000. Professionally qualified valuers have valued it at rupees 70,000. Journalize. Give the extract of SOCIE and SOPL. One more question from my side. Give the extract of SOCIE and SOPL. Give the extract of SOCIE and SOPL. Done. First write down the entry. Land does not have any accumulated depreciation. So whatever is the difference, debit land, credit revaluation surplus. Land account debit to revaluation surplus 20,000. And how will this be presented in the SOCIE and SOPL? Right. Presentation in SOPL, extract. Presentation in SOPL, extract. Part 2. First part is normal P&L account, income and expense related. Part 2, other comprehensive income. Under other comprehensive income, there are two categories. Those which will be subsequently classified to P&L account and those which will not be subsequently classified to P&L account. So it comes under that category, not classified subsequently. Not classified subsequently. Under that, gain on land revaluation, rupees 20,000. Gain on land revaluation, rupees 20,000. One line blank. Next write down presentation in SOCIE. Presentation in SOCIE. Extract. Write extract. And then under that, share capital, retained earning, revaluation surplus. These two items I am not writing because we don't have any information. This is only for presentation. Revaluation surplus total. Now opening balance, right now we don't know anything, just extract. change in equity for the year, again blank, comprehensive income for the year. Under comprehensive income, this 20,000 will come in the revaluation surplus column. And then you will get the closing balance. But right now you know only one figure. So this is just an extract. Okay. Now one more important thing we learn is transfer from revaluation surplus. Paragraph 22. One question number 23 there, homework. The revaluation surplus included in equity. The revaluation surplus included in equity in respect of an item of PPE may be transferred to retained earning when the asset is derecognized. Situation 1, when the revaluation surplus will be transferred to retained earning, when the asset is derecognized. Then you will not keep the balance of that asset in revaluation surplus. Okay. This may involve transferring the whole of the surplus when the asset is retired or disposed of. So when the asset is retired or disposed of, retired means it is not used in business anymore. It is held for sale. Or disposed of means sold or scrapped. However, some of this surplus may be transferred as the asset is used by the entity. One more policy choice is there. What you can do, every year, if you have revalued the asset upward, depreciation will be provided on the upward revalued amount. But when you provide the depreciation on the revalued amount, you are charging more depreciation to the SOPL. So the standard says that excess depreciation over and above what you would have charged under cost model will be transferred from revaluation surplus to retained earning, not general reserve. In this standard, it is revaluation surplus to retained earning. So the surplus will be transferred from revaluation surplus to retained earning. So dear student, the question is, how will you do that calculation? So let us first, I am going to write a rough example and then we'll going to take a problem. The cost of an asset was 1 lakh, okay, and it was revalued to 2 lakh rupees. Had I provided depreciation on original cost, I would have provided 10,000. But now I am going to provide, say, 20,000. How much is the difference between depreciation based on revalued carrying amount and the depreciation based on its original cost? 10,000. This 10,000 will be transferred from revaluation surplus to retained earning account. Entry will be revaluation surplus account debit to retained earning account, and where it will be presented in the SOCI. In revaluation surplus column negative, in retained earning column positive. Okay. Now we'll have a small practice on this. There is a question number 24 printed without answer. Students are required to complete. An entity owns a building which originally cost rupees 2 lakh. The property is depreciated over 50 years on SLM basis with no residual value. At the start of the year 2, the building was revalued at rupees 2,30,000. Show the treatment. So my question to all of you is, how much amount will be transferred from revaluation surplus to retained earning in the second year? how much amount you will transfer from revaluation surplus to retained earning in this second year? Got the answer? 791. Okay. Let me check. 694. The answer is 694. Right. Right there. Point number A. Original cost. So you will realize where you have gone wrong. Original cost is 2 lakh. Depreciation charge in the first year. First year normal accounting, 2 lakh divided by 50 years. 2 lakh divided by 50 years is 4,000. Right. WDV at the end of year 1 is 1,96,000. WDV at the end of year 1 is 1,96,000. Next line, write revalued amount. Revalued amount at the beginning of year 2 is 2,30,000. Revalued amount is 2,30,000. Point E, amount to be transferred to revaluation reserve. Amount to be transferred to revaluation reserve. D minus C. 34,000. 34,000. What is the depreciation charge for the year 2? Depreciation charge for year 2 is 2,30,000 divided by remaining years. 49. 49 because 1 year is over. So useful life is 50 minus 1 now. 49 years. 4694. Now under the original cost you were charging 4,000. Under revalued amount you are charging 4694. So we will transfer 694 from revaluation reserve to retained earning. Okay. Write down in the next box journal entry. For this last item, journal entry revaluation reserve account debit 694 to retained earnings 694 to retained earnings 694. Okay. So this is an example of how to deal with excess depreciation that you have charged on revaluation. Now next is a long discussion on depreciation. Depreciation is a systematic allocation of depreciable amount over the useful life that you have learned. Okay. Who has to decide the method of depreciation? The management. They know their business better. What you have to do, you have to choose a method such that the depreciation is charged systematically over the useful life of the asset. Method of depreciation is selected considering factors like type of the asset. So if it is building, maybe you can just follow SLM. But if it is a machinery, you can follow WDV. It depends on nature of use also. Whether you are working in single shift, double shift, triple shift, or other economic conditions. What is your maintenance policy? Do you maintain it regularly? Do you do the repairs and maintenance on a frequent basis? Because that might affect the depreciation calculation also. It also depends on how the economic benefit will be generated from the asset. So all these factors you have to consider and then make a choice as to which method of depreciation you will follow. The standard has permitted 3 methods. You can choose one of them. The simplest one is what companies follow is straight line method. That means the depreciable amount is allocated equally over the useful life of the asset. So write the formula here for depreciation. I know you know it, but still write down how much depreciation you will charge. The cost or revalued amount. In previous question we took revalued amount minus residual value divided by useful life or remaining useful life. Okay. And what about diminishing method? Here the depreciation is charged at a fixed percentage on the opening WDV. So every year the depreciation charge will reduce because the opening balance will keep reducing. Is it right? Now here in the second method, how do you calculate the rate of depreciation? Do you remember the formula for rate of depreciation? 1 minus residual value upon cost or revalued amount to the power 1 by n. N is the number of years or remaining number of years. If residual value is 0, assume 1. If residual value is 0, assume 1, because under WDV method, the balance of an asset can never become 0. So you can assume 1 if residual value is 0 given in the problem. If you take 0, then your answer will become 1 minus 0, 100%. Okay. So you write a note, if residual value is 0, use residual value equal to 1 in the formula. 1 or any other very small number you can take. Okay. You can take a very small number, 1 rupee, 2 rupees, doesn't matter. Be aware about this formula because we have seen in some exams they don't give you the rate for WDV method. And the next method is called unit of production method. This method is followed rarely in only some industries where the depreciation is based on number of units, number of hours, okay, or some basis they can use on the basis of which they can depreciate. Like say for example projector, 3000 hours is the life of the projector. We have consumed 250 hours. So 250 divided by 3000 into depreciable amount. Okay. In 1 year we have consumed 900 hours. 900 divided by 3000 into depreciable amount. The standard says follow component approach in providing depreciation. Now what do you mean by component approach? Sometimes an asset may have different components. One example we took today of a turbine, a machine which had a turbine inside it. Okay. Another example on the screen, just for the sake of example, car. Now in this car we have engine and we have tires. Can the life of engine and the life of tires be equal? No. So what you have been doing so far in accounting, car depreciated over 10 years, which means even the tire gets depreciated over 10 years, engine gets depreciated over 10 years, or the outer body gets depreciated over 10 years. So everything in that car 10 years. But actually it does not happen. After 4 years, you replace the car tires. You replace the tires because tire can be used only for 4 years. So in that case, what they are saying, if this is an asset, it has many components which have different useful life, because you need to replace those components after some time. then in that case the depreciation will be provided component wise, but that component has to be a significant component. There may be more than 1000 parts in this car. Am I going to depreciate all 1000 items separately? No. First of all those parts which have same economic life, same useful life, you can bundle them together. Secondly, all those items which have only significant value will be depreciated separately. So what is the threshold for significant amount? Maybe 10%. Is it right? So if a particular component value is 10% or more of the total asset value and its useful life is also different, then it will be depreciated separately, and all insignificant parts will be clubbed together and depreciated as one unit only. Is it right? Otherwise accounting will become very complicated. Company may have hundreds of assets, each asset have so many parts. So therefore what I will say, summary version of this, significant part whose useful life is different will be depreciated separately, others will be clubbed together. Now what about the replacement of that part whose useful life is different? We have solved one problem today. Actually we have done one example on this. The replaced part will be derecognized and the new part will be capitalized. Okay, solve one example. Write yourself. First write question also yourself. X Limited is a steel manufacturing company, commissioned a power plant at its steel plant at a cost of rupees 700 crore. The cost breakup of rupees 700 crore is as follows. Now this is a power plant inside a steel factory, okay, possible for captive consumption. And this power plant has 4 parts. Right there only. In the notes itself. Erection, fabrication and construction of building structure. Cost is 100 crore, its useful life is 30. Electrical panel installation. Cost is 50, its useful life is 10. Plant and equipment. 500 crore, useful life 40. Transformer grids. Cost 50, useful life 10. Calculate depreciation, this I have written. Residual value may be assumed to be 5%. Solve the answer below only. First 3 column you have to copy as it is. So maybe you can do that as homework, first 3 column. In column number 4, write down depreciable amount. First 3 column homework, okay. Last 2 columns write down the heading depreciable amount and depreciation. Depreciable amount will be cost minus residual value, and residual value is 5%. Means depreciable value will be 95%. So take 95% of 100. 95. 95% of 50. 47.5. 95% of 500, 475. 95% of 50, 47.5. Depreciation will be depreciable amount divided by useful life. 3.17, 4.75, 11.88, 4.75, 24.55. Right. In this example, you could have clubbed second component because it has a useful life of 10, and this fourth component also because that also has a useful life of 10. But if you do separately, there is no harm. What about the review of depreciation method? Depreciation method will be reviewed every year because what you had assumed earlier, estimated earlier, may change in the years to come. So this standard says depreciation method is reviewed at least at each financial year. Is your method right? If there is a change in the consumption pattern of the expected future economic benefit, okay, in case if the management thinks there is a change in consumption pattern of expected future economic benefit, then the depreciation method can be changed. So if you think that the future economic benefit pattern may change, earlier we might have thought we'll get equal amount in all the years revenue from this asset, but we may think that now revenue may be in decreasing order, so we might change from SLM to WDV. Next very important thing, change in depreciation method is called a change in accounting estimate. Okay, which standard talks about change in accounting estimate? IAS 8. And in case of change in accounting estimate, what does IAS 8 state? The effect will be given prospectively. Okay. Now we'll quickly summarize the important principles relating to depreciation. So at one place I have written all the important points. First is depreciation charge will begin when the asset is available for use. Okay. Available for use is important, actual use is not important. How do you know the asset is available for use? That is when it has reached the location and the condition necessary for it to be capable of operating in the manner intended by the management. So I have installed a generator set now. It is ready for use. But if there is no power cut for 2 months, will I not provide depreciation for those 2 months? I will provide depreciation charge separately for each significant part. Already done. You have solved one example. Depreciation charge ends. Up to which date you will provide depreciation? When the asset is classified as held for sale. Underline. Which standard deals with asset classified as held for sale? IFRS 5. Right? IFRS 5. Or if it is derecognized, depreciation charge will not be provided. Depreciation is charged even if the fair value of the asset is more than the depreciable amount. Market value of the asset is 1 lakh. Depreciable amount is 90,000. Still the depreciation would be charged because depreciation is systematic allocation of depreciable amount over the useful life. Repairs and maintenance charges does not negate the requirement of depreciation charge. What does this mean? Even if a company is maintaining the asset very efficiently, so management may argue that there is no need to provide depreciation. Still, you will say depreciation has to be provided even if the assets are maintained in good condition. When will you not provide a depreciation? If the residual value exceeds the carrying amount. Otherwise, the formula will give you negative depreciation figure. Cost is 10 lakh. Residual value is 11 lakh. Divide by 5 year. The answer is 0.20 negative. Will I charge negative depreciation? No. So for that point, till this point of time, till your residual value exceeds the cost or the carrying amount, you will not provide depreciation because you will end up providing negative amount. But once the residual amount falls below the carrying amount, you will resume providing depreciation. Okay. Method of depreciation, SLM WDV production unit method. That means on the base of number of units produced. And depreciation does not cease when the asset remains idle. If generator set is not required, when there is no power cut, depreciation will be provided. Or depreciation does not cease when the asset is retired from active use, unless the depreciable amount is 0. Okay, now we'll solve one question. ABC Limited purchased on credit an asset costing rupees 5 lakh during the year 2003. It charges depreciation at the rate of 15% WDV on these types of assets. During the year, it has paid rupees 2,20,000 to the supplier, including the interest for the delayed payment. Rupees 3 lakh together with interest will be payable next year. The amount of depreciation provided for the year is rupees 33,000. That is 15% of rupees 2,20,000. Comment. Is it wrong? What is wrong? Should we provide depreciation on the payment made to supplier? Or should we provide depreciation on the cost? Okay. So this is a gross error on the part of this company. Depreciation should be provided on the cost, that is 5 lakh into 15% 75,000. Interest for delayed payment should not be considered for providing the depreciation. Try one more. Y Limited has purchased a plant for rupees 1 crore 50 lakh. Its expected useful life is 10 years. Estimated scrap value is rupees 10 lakh. The company charges depreciation based on straight line method. In the 4th year, the life is revised to 8 years. What accounting adjustments are required? So first of all, what you do, you calculate how much depreciation you have provided. How many years are over? 3 years are over, na? 3 are over. In the 4th year, we are revising the useful life. So 1 crore 50 lakh minus 10 lakh divided by 10 years. So annual depreciation is 14 lakh. Is it 14 lakh? And how much you have provided? 3 into 3. So total depreciation we have charged so far is 42 lakh. Do you agree? So after providing 42 lakh, the carrying amount of the asset will be 1 crore 50 lakh minus 42 lakh. How much is that? 1 crore 8 lakh. I'll write it for you. Cost is 150 less depreciation for 3 years 42. So 108. So this is my carrying amount right now. And the revised useful life is 8 years. So what is the remaining useful life? 5 years. And what is the scrap value, residual value? 10. So my depreciation will be 108 minus 10 divided by 5. So per annum depreciation will be how much? Is it 19.6 million or 19.6 lakh, sorry? Yes. This way you have to write the answer. Okay, solve one more. Search for this question at the end. B Limited owns an asset with an original cost of 2 lakh rupees. On acquisition, management determined that the useful life was 10 years and the residual value was 20,000. The asset is now 8 years old and during this time there have been no revision to the assessed residual value. What is this question number? 68. Oh, you are able to reach so fast. So after 8 years, the management has reviewed the useful life and residual value and determined that the useful life can be extended to 12 years. So how many more years are remaining now? 4. 8 are over. 2 was originally remaining, but after the revision in useful life 4, as a result the residual value will be 10,000 rupees now. How would the above change in estimate be made by B Limited? So how will you adjust your depreciation? So what I'll do, I'll first find out what is the carrying amount of the asset right now. Carrying amount of the asset will be 2 lakh is my cost, and depreciation you have charged per annum 2 lakh minus 20,000 divided by 10 years into how many years are over? 8 years are over. So will you be able to tell me what is the amount of the what is the carrying amount of this asset after 8 years now? Haji? 56,000. Is it 56,000 now? Carrying amount 56,000. Remaining useful life 4 years. Revised scrap value 10,000. So your revised depreciation will be 56,000 minus 10,000 upon 4. So how much you are getting? Is it 11,500 per annum? Right? So that way you will solve. Okay, we'll try this one also quickly. Search for this question. XYZ Limited purchased an asset on 1st January 20x0 for 1 lakh, and the asset had an estimated useful life of 10 years. Residual value is nil. Question number 66. The company has charged depreciation using SLM 10,000 per annum. On 1st January 20x4, how many years are over? From 1st January 20x0 to 20x4, 4 years are over. Yes or no? The management of XYZ reviews the estimated life and decide that the asset will probably be useful for a further 4 years, and therefore the total life is revised to 8 years. How should the asset be accounted for remaining years? So first we will calculate what is the carrying amount after 4 years. The carrying amount after 4 years will be 1 lakh minus 10,000 into 4 years. 10,000 per annum depreciation, 60,000. What is the remaining useful life? 4. So what is your annual depreciation? Is it 15,000? 15,000 will be charged over the next 4 years. Okay, try one more quickly. An entity acquired an asset 3 years ago at a cost of rupees 5 million. Is it 61? The depreciation method adopted for the asset was 10% WDV. So this time I am changing the method WDV. At the end of 3 years, the entity estimates that the remaining useful life of the asset is 8 years and determines to adopt SLM from the date so as to reflect the revised estimated pattern of recovery of economic benefit. Show the necessary treatment as per IAS 16. Now first of all you have to find out what will be the carrying amount at the end of 3 years. What is the carrying amount at the end of 3 years? Can you find out? Huh? 5 million means 50 lakh into 0.9 into 0.9 into 0.9. Why into 0.9 3 times? It is getting depreciated 10% every year. So can you tell me how much is the carrying amount after 3 years? 36 lakh 45,000 approximately or exactly? Exactly 36 lakh 45,000. How many years are remaining now? 8 years are remaining. So divide by 8. So depreciation under SLM method, this number divided by 8, 4 lakh 55,000 625 approximately. In your answer sheet they have written 4 lakh 56,000. That they might have rounded off. Is it right? They have charged, no? Why? 5 lakh 4 lakh 50,000 and 4 lakh 5,000 they have written. So 3 years are over. While calculating. While calculating. No problem. So this way you solve. Okay, now we'll come to derecognition. Question number 60, note down homework. 60. Question number 59, note down homework. 59 and 60, similar problem. Now we'll come to derecognition. Opposite of recognition, derecognition. Now we'll come to derecognition, come to para 27. It is opposite of recognition. That is, now the asset will be removed from the books of account. It won't be appearing in the books anymore. It won't appear in your property, plant, equipment list. So when will you derecognize a PPE? When it is disposed of. Okay. And when no further economic benefit is expected out of the usage. No further economic benefit is expected means you are not going to get any benefit out of it. It's of no value to use. Neither you are going to use it for production, rendering of service, rental, administration purpose, nor you are going to sell it also, because it does not have any sale value also. So in this case, derecognize the asset from the books of account. Disposal. What are the modes of disposal? Disposal can be by way of sale. Disposal can be by way of donation also. Or disposal can be by way of entering into a finance lease. You will see the finance lease IAS 17 later. In finance lease, what we do? If we are the person who is lessor, we will derecognize the asset from our book, and it is the lessee who is going to recognize the asset. Okay. So the lessor will derecognize the asset in case of finance lease, and he will recognize finance lease receivable as per IAS 17. Now when you are going to derecognize an asset, there can be gain or loss. Where will the gain or loss be recorded? Only one answer. SOPL, statement of profit or loss, whether gain or loss. And in case any balance in revaluation surplus lies, then that will be transferred to retained earning, not through P&L account, directly through SOCIE. Solve some simple example. Question 28 below. WDV of an item of PPE is rupees 10 lakh. The asset is sold for rupees 12 lakh during 2016. Underline, the buyer will pay the sale proceed after 1 year. The buyer will pay the sale proceed after 1 year means what is the cash price of the asset sold? This 12 lakh he will pay after 1 year. It means it includes the interest component. Remove the interest. Okay, the company shall derecognize the asset and recognize receivable at the discounted value of 11 lakh. This is their calculation, discounted value. How should it be accounted as per IAS 16? Take 1 year borrowing rate of buyer for discounting. Assume that it is 10%. So what we will do, we will calculate the present value of this 12 lakh. How much is the time period in this problem? 1 year only. So the present value will be take 12 lakh divided by 1.10. How much is that? 10 lakh 90,909. And what they have done here in the question, they might have done the rounding off. Is it right? Don't take this figure. Take this figure. This is the cash price of the asset sold. Remaining difference next year you will treat it as interest income. And what is the book value of the asset sold? 10 lakh. Compare it with the present value. Gain or loss? Gain. Book value 10 lakh, cash price 10 lakh 90,000. So gain of 90,909. So the entry will be receivable account debit. The present value of 12 lakh, because remaining difference is the interest portion, to PPE account 10 lakh, and to profit on sale of PPE account transferred to P&L account 90,909. Okay. Para 28, compensation from third parties. So you have a machine, you have taken an insurance. Insurance company says that in case of loss or damage to the machine, we will compensate you. Suppose that machine got damaged, lost. So you are entitled to insurance claim now. So that is called compensation from third party. So compensation from third party, the simple example is insurance cover or a guarantee, okay, given by the manufacturer. When will compensation be recognized? So the treatment is compensation from third party for item of PPE that were impaired shall be included in the profit or loss. So that compensation received or receivable will be shown as income in the profit or loss when compensation becomes receivable. First you will recognize the loss and then you will recognize the gain, that is profit, only if the compensation becomes receivable. That means the insurance company have accepted your claim. Okay, payment may be made to you later, but at least now in principle they have agreed to pay you the claim. Solve question number 29. Entity A carried plant and machinery in its books at 2 lakh. They were destroyed in a fire. The assets were insured new for old. What is the scheme? New asset will be given if it is destroyed and were replaced by the insurance company with the new machines that cost rupees 20 lakh. The machines were acquired by the insurance company and the company did not receive rupees 20 lakh as cash compensation. State how entity A should account for the same. How entity A should account for the same. So what will you do? First you will recognize the loss of 2 lakh rupees. But this 20 lakh compensation they have not yet received. So that will be recognized as income only after the compensation becomes receivable. So first you will write entity A should account for the loss in the SOPL on derecognition of the carrying value of plant and machinery as per IAS 16. Entity A should separately recognize the receivable and gain in the SOPL resulting from insurance proceed. Underline once the receipt is virtually certain. The receivable should be measured at fair value of the asset that will be provided by the insurer. So whenever the asset is provided by the insurer, then in that case the entry will be respective asset account debit to profit and loss. 20 lakh asset will come to you and the 20 lakh cross credit entry will go to profit and loss. Yes, gain. Now the new asset is worth 20 lakh. Okay, solve this question also. This is there in your book somewhere. X Limited has a machine which got damaged due to fire on 31st January 2000 X1. The carrying amount of the machine was 1 lakh on that date. X Limited sold the damaged asset as scrap for rupees 10,000. X Limited has insured the same asset against damage. This is for damage. On 31st March 20X1, compensation proceed was still in process, but the insurance company has confirmed the same. So you are going to receive compensation of 50,000 is receivable from insurance company. How X Limited will account for the above transaction? So now what will be your answer? How much is the loss in this example? 90,000. 1 lakh is the carrying amount. You could sell it for 10,000 now. So that 90,000 loss will be recognized. Asset will be derecognized. And you are also going to recognize an income of rupees 50,000 as compensation receivable in the statement of profit and loss, because this question clearly mentions that insurance company has confirmed the claim of rupees 50,000. So 50,000 rupees will be recognized as income. Now we are almost towards the end of this wonderful chapter, scrapped asset. What is the meaning of scrapped asset? Asset which is not of any economic benefit to the enterprise. So if it is scrapped, it is removed from PPE category, and suppose it has got some value, then it will be classified separately if there is any realizable value. Okay? If it is having zero realizable value, we have discussed, derecognize. But if it has some value which you think might be realized whenever we'll sell this as scrap, then you record it at that realizable value as a separate item, not as a PP item. Because PP means those assets which are used for production. Is it used for production? No. Rendering of service? No. Rental? No. Administration? No. Scrapped asset is classified into current asset. If the scrap is expected to take place in 12 months, but if it is expected to be sold beyond 12 months period, then that scrapped asset will be classified as non-current. So that is a presentation in the SOFP. Scrapped asset will be measured at NRV. So you will continue to show it in the SOFP at NRV. Scrapped or abandoned asset are distinguished from non-current held for sale. We will see the meaning of non-current asset held for sale in IFRS 5. They are also like scrapped asset only, but there is a difference. Scrapped asset means management is not actively looking for a buyer. They have not made a plan to sell. It is there. They will sell it in future. But non-current asset held for sale means there are some terms and conditions that is needed to be satisfied to be called as non-current asset held for sale. Like for example, management is actively looking for a buyer to whom this asset could be sold. They have taken all the efforts to sell that asset. They have made the publicity of that asset that it is to be sold. So therefore scrapped asset is different from non-current asset held for sale. Assets which are temporarily taken out of operation are not classified as abandoned asset or scrapped asset. So they will continue to be depreciated. Now below this you will find there is a big case study problem. Okay, almost runs into 30-40 lines. And then the answer is also printed. So we'll try to understand the answer. On 1st April, so many concepts will get covered in this example. On 1st April 20x1, Sun Limited purchased some land for rupees 10 million, including legal cost of rupees 1 million. This 10 million includes legal cost of 1 million. Do I need to write 10 lakh or 11 lakh? 10 lakh. So you keep the answer in front of you and you tick mark those items which we have discussed and understood. Basically the question is to find out the total value of PPE and how much depreciation you are going to charge. Is it right? So first you tick mark their land in the answer. And when was the land purchased? On 1st April 20x1 for 10 million. Legal cost is included in the cost of land. That is correct. We don't have to make any adjustment for this 1 million. Okay. Then in order to construct a new factory, construction work commences on 1st May. Now this will be required for doing some calculation. 1st May. Sun Limited incurred the following costs in relation with the construction: preparation and leveling of the land, 3 lakh. Will you capitalize it? Yes. So this is a direct cost of constructing the factory. 3 lakh tick mark. Purchase of material for construction, 6.08 million in total. That is also direct cost. Add tick mark. Employment cost of construction worker 2 lakh per month. Now we have to see when the construction work completed. Can you just find out somewhere below when the construction work got completed? The factory was completed on 30th November 20x1. Is it there below? So count the number of months from 1st May to 30th November. How many months? May, June, July, August, September, October, November. 7 months. 7 into 2 lakh. Is it 14 lakh? Rupees in thousand they have mentioned. So tick mark. Overhead cost incurred directly on the construction of the factory, 1 lakh per month. Please multiply 1 lakh into 7 months. 700. Keep writing the calculation. 1 lakh into 7. 2 lakh into 7. Ongoing overhead. Now understand this one. Ongoing overhead cost allocated to the construction project. Now these overheads companies incurring in any case using the company's normal overhead allocation model. Now this is allocated overhead. This is not directly attributable to bringing this factory building. They are incurring overhead. Now they have allocated some to this also. So write nil, allocated, not a direct cost of construction. Remark, not a direct cost of construction is printed there. Then income received during the temporary use of factory premises as a car park. Very good. During the construction period, 50,000. Now in case if you generate some temporary income during the construction period, it is transferred to income statement, profit or loss. So nil. There is a note written, not essential in the construction, so recognized directly in profit or loss. Income received from temporary use of such asset is not adjusted in the cost. It is taken to statement of profit and loss. What about this item? Cost of relocating employees to work at the new factory. We have discussed this. Relocation cost not to be capitalized. Note, not a direct cost of construction. Cost of opening ceremony, 1,50,000, not a direct cost of construction. Next paragraph. The factory was completed on 30th November and production began on 1st February 20x2, which means the factory is available for use from this date onwards. For temporary period it was not working till 1st February 2002. The overall useful life of the factory building is 40 years from the date of completion. Okay. Factory was completed on 30th November. So 40 years is the life of factory. However, it is estimated that the roof will need to be replaced 20 years after the completion. So there are two components here, factory building and roof. Factory has a life of 40 years, roof has a life of 20 years, and the cost of replacing the roof at the current price would be 30% of the total cost of the building. So out of the total cost, 30% is roof. So roof will be depreciated over 20 years. Remaining factory building cost will be depreciated over 40 years. So first I need to find out what is the total cost of factory building. Then we will apportion it 30% and 70%. At the end of 40-year period, Sun Limited has a legally enforceable obligation to demolish the factory. So remember, one more cost you have to add. Cost of restoration, decommissioning, and restore the site to its original condition. The directors estimated that the cost of demolition in 40-year time will be 20 million. At annual risk adjusted discount rate which is appropriate to this project is 8%. So you have to calculate the present value of 20 million at 8% discount rate, time is 40 year. The present value of 1 rupee payable in 40-year time at an annual discount rate of 8% is 4.6 cents, means 0.046. Multiply 20 into 0.046. Ji 9.2. Tick mark that 920. Multiply there. Write down in bracket there. 20 million means 20,000 in 1000 and 0.046. 4.6 cents. Suppose in the exam you don't understand this, do yourself. Take 20 million, divide by 1.08 and press 40 times equal to. Is it right? You can do like this also on your own. But don't make mistake. 20,000 divided by 1.08 to the power 40 will roughly come to this number. If you can understand this, then you can use this factor. So this also I will add. Now one more thing, the factory construction of the factory was partly financed by a loan of 17.5 million. Type this number, 17.5 million, taken on 1st April 20x1. And we had also purchased the land on 1st April 20x1. That means the capitalization will begin. Capitalization will begin under IAS 23 when you have taken necessary steps to construct the qualifying asset and get it ready. Is it right? So, and when was the activity complete? 30th November. You are allowed to capitalize only once the asset is substantially complete under IAS 23. So how many months from 1st April to 30th November? 8 months. So type on your calculator 17.5 million into 8 by 12 into 6%. Into 6%. So that is the borrowing cost you will capitalize. Anybody, any answer? 17.5 million into 8 by 12 into 6%. but what is the condition? The activity necessary to get the asset ready for its intended use should begin. So even when you purchase the land, then also your activity that is required to get the building ready. Yes. So type how much you are getting. 700 you are getting for 8 months or 7 months? 8 months. See your note there. Explanation of why we have taken 1st April. Capitalize the interest cost incurred in an 8-month period because the purchase of land would trigger off the capitalization. 3 conditions are required to be satisfied under IAS 23. First, borrowing cost must be incurred, so that we have incurred. Second, expenditure on qualifying asset must be incurred. Third, the asset or the activity necessary to get the asset ready for its intended use are in progress. Okay. So the purchase of land is a triggering event, and from that date onwards you can capitalize the borrowing cost over the building, because unless you buy the land, your building cannot start. No, you don't agree? You should agree. How will you construct the building without buying the land? Because they have started the process. Process does not mean some activity has to be there. To get the plan, suppose you bought a land, you can't start the construction on the same day. You have to get the plan. You have to get the architect, go to the municipality, get the approval. Once they approve, then you start construction. Is it not the activity required to get the asset ready for its intended use? So you can't start construction on the same day, but any such administrative activity which is also required to get the asset ready for its intended use is also considered. And wait, have you added 700 there? Show is not over. The Sun Limited received an investment income of rupees 1 lakh on the temporary investment of the proceed. Now go to IAS 23 again. Any investment income on a specific borrowing will be reduced from the cost of borrowing. So reduce 100 there. They have written there 100 negative. Offset against the amount capitalized. Required. Compute the carrying amount of the factory in the balance sheet of Sun Limited on 31st March. You should explain your treatment of all accounts referred to in this part in your answer. Now first you tell me the total of that first table. Total. Is it 20,000? So 20,000 is total value. Wait. Out of 20,000, land is 10,000. 20,000, land is 10,000. You are not going to depreciate land. So depreciation calculation will be divided into 3 parts. First part, in your note it is not printed, land whose value is 10,000. Depreciation will be 0. Second will be roof. Roof component. Out of 20,000, roof component is 20,000 minus 10,000 first. 10,000 and remaining 30% into 30%. That is the amount allocated to roof. Roof has a life of 20 years, divide by 20. But this year only 4 months are complete out of 12. Which 4 months? On the screen, the factory was completed on 30th November and year ending date is 31st of March. Count how many months? 4 months. Is right 4 months into 4 by 12. So tell me the answer of roof part. 10,000 into 30% into 4 by 12 into 1 by 20. Is it 50? And third is the remaining factory building. So same calculation but divide by 40. 20,000 minus 10,000. 10,000 into 70% into 4 by 12 into 1 by 40. Why 40? Because the life is 40 years. How much is that? Is it 58? Round off 58. So my total depreciation charge will be 108. So the amount at which asset will appear in the balance sheet would be 20,000 minus 108. How much is 20,000 minus 108? 19,892. Is it matching? 20,000 is the total amount capitalized. Depreciation is 108. So 19,892. Okay. So this was this wonderful question for around 16 marks in the exam. Come to the disclosure part. Disclosure part is simple. Already you know it. You have been doing in the offices. Same thing. In the financial statement, you disclose the gross carrying amount and accumulated depreciation at the beginning and at the end of the period. In the notes to account, you will disclose measurement basis, depreciation method, that is you are following cost model or revaluation model. Then depreciation method, whether you are following SLM, WDV or unit of production. Depreciation rate or useful life. Reconciliation of carrying amount at the beginning and at the end of the period, which will show the addition, asset held for sale, asset acquired through business combination, revaluation, impairment, depreciation and exchange difference. So from the opening till closing, whatever change that have taken place, you have to write. An existence of restriction for assets placed as security. Asset under construction will be shown separately. So they call it capital work in progress. And then contractual commitment to procure the asset will be shown separately in the notes to account. And for the revalued item, there are some more conditions. Effective date of revaluation, whether any independent valuer was involved, method and assumption used, corresponding carrying amount if cost model had been followed. So revaluation is not easy. Once you are willing to comply with the other conditions and disclosure requirement, then you can follow the revaluation model. Okay. After this, now in the last part, what we will discuss, this is the last part. Any change in existing decommissioning, restoration and similar liabilities. I took one question just now where there was one decommissioning liability, but the decommissioning liability can change. Why? Because it is an estimated number. It can change either because management thinks that the amount to be paid will be more or less due to whatever developments that have taken place in that field, or the discount rate may change. Even the change in discount rate may affect the calculation of decommissioning liability. So first we will discuss on day one what we will do, subsequently what we will do, and if there is a change in the decommissioning liability, then what we will do. Okay. So this next few paragraphs will completely deal with decommissioning related items. An entity is required to include in the cost of item of PP initial estimate of cost of dismantling and removal and restoring the site on which it is located. Already discussed in that previous question also. Estimate the decommissioning cost, discount it and include it in the cost of PPE, and the second effect will appear in the liability side as decommissioning liability. The initial estimate is correspondingly recognized as liability in accordance with IAS 37. So what you do, just write one line, example of decommissioning expenses. Where do we use decommissioning? This I have added just now. Decommissioning expenses are capitalized in case of mining. If the government gives you license for mining, once that mining activity is over, you have to restore the land in the original condition, and that takes a lot of cost. Then in case of oil exploration, you may have created those oil rigs, you have to remove them. Then nuclear plant, once the life is over, you have to restore the environment. It's a very expensive affair. Hydroelectricity plant, where there are liability for site restoration. Is it right? These are examples of situations when decommissioning expenses being very huge, the companies need to provide for it. Now write in the notebook because I have to give all journal entries. So keep writing journal entries. This is day 1 entry. PPE account debit to provision for decommissioning expense. If you can't write such a big line, provision for decommissioning expense, you can write on decommissioning liability account. Okay, but it is ultimately a provision, so there is a reference of IAS 37 there. Now after this, what is the amount we have discussed? Present value of that liability. So every year what will happen? Interest will be calculated. Is it right? And the credit effect will be given to liability account. So interest account debit to liability, interest to liability, so that on the maturity, the book value of the liability will become equal to estimated amount of liability, and that interest expense will be transferred to statement of profit and loss every year. Okay, so write one small question on decommissioning expense in the notebook. Question on decommissioning expense. Question write down. ASF Mining Limited has projected site restoration expense of rupees 1,57,04,710 after 40 years. So this is the amount you expect to incur after 40 years. The rate of discount is 11%. The rate of discount is 11%. Pass journal entry at initial recognition. Pass journal entry. So first what you will have to do, you have understood, you have to compute the present value of this. So you have to type on your calculator this number, divide by 1.11 and press equal to 40 times. This is how I know. If you know any other method, you follow that. So who got the answer? Present value. Just see, is it close to 2,41,608? Exactly same amount. So write down step 1. Don't pass the entry for this amount. First compute the present value. It is 241,608. Write down present value of estimated restoration expense. Present value of estimated restoration expense take this number into present value factor 11% comma 40 years. You will get 241,608. How to get it on your calculator? I have told you, type this number, divide by 1.11 and press equal to 40 times. In the exam, they may or may not give you the present value factor. Be self-dependent, right? Journal entry in the first year. Journal entry in the first year. First entry would be, initial entry would be PPE account debit 241,608 to provision for decommissioning expense 241,608, being recognition of decommissioning liability, being recognition of decommissioning liability. And at the end of the year, even though they have not asked it, suppose they ask you what entry will you pass at the end of year 1, we should be ready for that. We are going to calculate the interest or finance cost on 241,608 at 11%. Try 26577 to provision for decommissioning expense 26577. Okay. In the balance sheet or in the statement of financial position, your liability value will increase by 26577. And what about this finance cost? Third entry, this finance cost you recognize in statement of profit and loss. So finance cost account debit to, P&L account debit to finance cost 26,577. What is grouping? Short term provision. No, this is not short term, this is long term provision till 39 year. Under short term provision, you can give it a particular head, same heading, or maybe other provisions. Okay. Depend on company, what are the accounts they want to create. It's a financial or non-financial liability. You have to incur this expenditure. So non-financial liability, because there is no particular obligation to pay to any particular person. This is what you will incur at that point of time. Now write down, what about the next year entry? Next year first entry will not come. Second entry will come, but with a different amount, because my liability balance will change every year. If my liability balance is changing every year, my interest figure will also change. And this entry you will pass for how many years? 40 years. And in the last year, you are going to incur the decommissioning expense. Assuming that there is no change in the estimation, write down in your notebook journal entry in the last year. How these accounts will close? Journal entry in the last year. Assuming that there is no change in the estimation, you will incur decommissioning expense account debit to bank. And by this time, your balance in provision for decommissioning expense account will also be 157,04,710. After adding interest every year, this decommissioning provision account will be closed now by knocking it off against the decommissioning expense. Being decommissioning expense charged to provision account. So this is how this provision account will be closed. If you don't want to pass two entries, you can pass one only. Provision for decommissioning expense to bank. Okay. So this is assuming these entries that you have written, assuming no change in the estimate. But then your institute will not leave you early. Change in existing decommissioning, restoration and similar liabilities. So why change may happen? Reason for change? A change in estimated outflow of resources embodying economic benefit. Possible? Because after 40 years what you will pay is only an estimation, and as you get more information, your estimates may change, both plus minus. Change in the current market based discount rate. So the discount rate might also change. You took 11%, that can also change. If discount rate will change, the present value of the liability will change, or an increase that reflects the passage of time only. That is, the liability is increasing every year because of unwinding of discount. Because of unwinding of discount, I don't have to do anything except this entry for finance cost. Now, the institute says the accounting for change in decommissioning liability depends on what is the accounting measurement model you are following. Are you following cost model or are you following revaluation model? Because if you are following revaluation model, then we have a different treatment, because revaluation surplus is there and that might be adjusted if there is a change in the liability. But if there is a cost model, then there is no problem. You are going to make an adjustment in the asset value and the liability value. So first point below, related asset is measured using cost model. Cost model, I hope you remember. Asset is capitalized at cost and subsequently only depreciation is charged. If required, impairment loss is charged. There is no balance in revaluation surplus anywhere. Okay. Now here a decrease in the liability. Liability has decreased. Will be reduced from the carrying amount of the asset. A decrease in liability is reduced from the carrying amount of the asset, because you had capitalized it also long back, remember. But there is a limit here, we'll discuss. What is the entry you will pass? Provision for decommissioning expense account debit to PPE account. Write down. If you don't want to write, still write. Provision for decommissioning expense account debit to PPE account. Now suppose your liability decreases, but it is more than the balance in the carrying amount of the asset. Then what will you do? The excess will be recognized in profit and loss. Okay. Decrease in liability is 1 lakh, but you are depreciating the asset maybe at a higher rate. So the value of the asset is much lower. So the excess amount will be transferred to profit and loss as a gain. So provision for decommissioning expense account debit to PPE account to profit and loss account. What about increase in liability? Reverse this first entry. But then at the same time, if you reverse the first entry, means your PP balance will go up. One standard will come into picture. Standard on impairment. The standard on impairment say, okay, you can increase the value, but it should not be more than the recoverable amount. It should not be more than the recoverable amount. By passing an entry, you just can't increase the value to any amount you want. An asset in the SOFP should not be shown above the recoverable amount. So entry will be PP account debit to provision for decommissioning expense. But if you have to restrict the increase here, then the remaining amount you will charge to P&L account. Okay. Suppose I want to increase the liability by 100, but my AS or IAS 36 impairment says you can only increase it to 90. So where will this remaining 10 we will transfer? The remaining 10 we will treat it as a loss and transfer to profit and loss. Okay. Solve one question in your notes. It is printed somewhere. Oh, it is printed there only. Below. Is it there? 31. Don't read the answer. Wait. An entity has a nuclear power plant and a related decommissioning liability. The nuclear power plant started operating on 1st April 2017. The plant has a useful life of 40 years. Its initial cost was 1,20,000, which included an amount for decommissioning cost of 10,000. Included means 1,20,000 includes 10,000. And how this 10,000 they have calculated, which represented 70,400 in estimated cash flow payable in 40 years, discounted at a risk adjusted rate of 5%. Now don't sit in the exam and do the calculation. It is given 70,400 discounted at 5% for 40 years gives you 10,000. You can check it as homework. The entity's financial year ends on 31st March. Now right here on 31st March 2027 means after how many years? 10 years. After 10 years, the value of the decommissioning liability has decreased by 8,000. The discount rate has not changed. How the entity will account for the above changes in the decommissioning liability if it adopts cost model? How many years are over? 10 years are over. So we'll have to see what is the balance in the asset account after 10 years. What is the balance in decommissioning account after 10 years? How many years are remaining for the calculation of depreciation? Is it right? 10 years are over. Original life is 40 years. So you answer my some basic question. How much depreciation they must have provided so far? 1,20,000 divided by 40, so 3,000 per year. And how many years are over? 10. So total depreciation they have charged. Is it 30,000? Yes, keep that in mind. And what will be the balance in decommissioning cost after 10 years? 10,000 into, it is increasing at what rate? 5%. Every year 5% is getting added to this. So take 10,000 into 1.05 to the power 10. In your answer printed, they have not explained properly. Just try. Is it coming to 16,300 approximately? Approximately. I will keep the same numbers which is printed in the notes. One student had called me, sir, how 16,300 has come? This is how it has come. And if it is not matching with your calculator, They have rounded off the last 2 or 3 digits. Is it right? So 16,300. Now they want to decrease this liability by 8,000. So 16,300 minus 8,000. So the revised decommissioning liability will become 8,300. What will be the revised carrying amount of the asset? Asset cost is 1,20,000. Depreciation provided 30,000. So right now it was 90. And you are going to further reduce it by 8,000. So the balance will be now 81,000. 82. And how many years are remaining now? 30 years. So what will be the depreciation you are going to provide for those remaining 30 years? 82,000 divided by 30. Anybody? 2733. And how much finance cost you are going to recognize in the 11th year? Discount rate has not changed. So the finance cost for the next year will be 8300 into 5%. Try, is it 415? 8300 into 5%, 415. Now you first read, and whatever I have explained, pay attention on that. Your depreciation provided so far 30,000. So carrying amount is 90,000. The current carrying amount of decommissioning liability, because it is increasing at 5% every year, is 16,300. This you want to reduce by 8,000. So the entry will be asset liability account debit 8,000 to asset account 8,000. Both will reduce by 8,000. Fixed asset revised value over remaining useful life 2733, depreciation every year, and this finance cost for the next year would be this revised value into 5%. Okay. Now you read this note, or you will read it as homework. Okay, very good. Because this question students have called me and asked me the explanation how this number has come. Understood now? And there is a note below at the end of the answer. If the change in liability had resulted from a change in discount rate instead of change in the estimated cash flow, the accounting for the change would have been the same, but the next year finance cost would be based on the new discount rate. Suppose they say discount rate is 6% now. So in this case your answer 415 will change and it will become 8300 into 6%. Is it right? That much change you will be able to do in the exam? Right. Now we'll stop today. We'll continue tomorrow.